Value takes center stage as America's AI boom enters a new phase in 2026. After years of relentless enthusiasm for artificial intelligence driven equities, global investors are preparing for a strategic recalibration in 2026, one that places the United States at the heart of the renewed hunt for undervalued assets as concerns glow that the AI rally may be approaching maturity. Market participants are increasingly looking beyond richly priced technology giants towards sectors and asset classes where value, rather than type, may define the next leg of return. US equity market endured sharp swings in 2025, rattled by President Donald Trump's aggressive tariff regime that briefly pushed stocks toward bear market territory in April. Yet the turbulence proved temporary. By year-end, American indices has rebounded to record highs, reaffirming the United States' central role in global capital market. Analysts now expect his momentum to carry into 2026, albeit with a more selective, discerning investment approach. This is an environment tailor-made for active investing, strategists at BlackRock's Investment Institute observed, reflecting a growing consensus that broad-based rallies are giving way to precision stock picking. One of the most closely watched shifts in unfolding with US small cap stocks, long overshadowed by mega cap technology leaders, smaller American companies are beginning to show signs of earnings revival that as borrowing costs are expected to ease. With markets pricing in two interest rate cuts from the Federal Reserve in 2026, heavily leveraged small caps stand to benefit disproportionately. The Russell 2000, the benchmark for US small cap equities, could rise nearly 14% by the end of 2026, according to Jefferies, marking a notable reversal after years of underperformance. For investors, this resurgence underscores a broader theme. Value is quietly reasserting itself within the American market. The Federal Reserve's anticipated pivot toward rate cuts is also reshaping expectation for currencies and commodities. The US dollar, which has long dominated global reserves, is widely forecast to weaken further in 2026, reflecting both looser monetary policy and political uncertainty surrounding future Federal Reserve leadership. This backdrop has reinforced gold's appeal after its strongest annual performance since the late 1970s. The precious metal continues to draw support from central banks seeking to diversify away from dollar-dominated assets, while gains may moderate. Gold remains a key hedge against shifting US monetary dynamics. Beyond financial market, investors are increasingly focusing on sectors tied to the real US economy. Healthcare stands out, buoyed a policy tailwinds and the expanding commercial impact of weight loss and metabolic drugs. Financials, particularly American banks, are also regaining favor as merger activity accelerates, the loan growth rebounds. Deregulation and efficiency gains driven by AI adoption have made US mid-cap banks especially attractive, positioning them as early cycle beneficiaries of an improving domestic outlook. Even as investors diversify globally, the gravitational pull of US policy remains